Hey everyone, welcome back to the channel. Today we are diving into the 7 golden rules for traders. Principles that, when followed, can take your trading game to the next level. These aren't just any tips, they are timeless strategies used by the pros to stay ahead in the wild world of trading. Stick around until the end because these golden rules can make or break your trading career. Let's get into it. The first rule is discipline and patience. The foundation of successful trading is having the discipline to stick to a proven strategy and the patience to wait for the right opportunities. Charlie Munger once wisely remarked, if all you ever did was buy high quality stocks on the 200-week moving average, you would beat the S&P 500 by a large margin over time. The problem is, few human beings have that kind of discipline. What it means is that most traders fail because they can't stay committed to a plan long enough. You have to believe in your strategy and resist the urge to abandon it in the first signs of trouble. Patience is what separates the amateurs from the pros in trading. The second rule is cut your losses early. In trading, the key is knowing when to walk away. If a trade starts going against you, it's essential to cut your losses early rather than hoping the market will turn in your favor. Think of it like a train journey. If you realize you are on the wrong train, it's much smarter to get off at the next station rather than staying on and making the trip even more expensive. Remember, the longer you let a losing trade run, the more it can erode your capital. To win big, first avoid losing big. The third rule is never average down on losses. A common mistake that even experienced traders make is averaging down on a losing trade. Buying more of a stock as its price falls, thinking you are lowering your average cost. In his book, How to Trade in Stocks, J.S. Livermore cautions against this. Many traders buy a stock at 50 rupees and when it drops to 47, they are tempted to buy more, thinking they have lowered their overall cost. But this often leads to deeper losses. For example, if you are buying at 50 rupees and the stock drops to 44, you are suddenly looking at much bigger loss. Instead of doubling down, a better strategy is to accept that trade didn't work out and cut your losses. The fourth rule is study your mistakes. Every trade, whether profitable or not, holds valuable lessons. The best traders don't just celebrate their wins, they carefully study their losses. After every trade, do a post-analysis to understand what went right and what went wrong. Was your entry point fraud? Did you miss some important indicators? Was your exit too early or too late? The more you analyze your mistakes, the more you will sharpen your skills. That's where real growth happens. In fact, your biggest breakthroughs will come from the lessons you learn from your errors, not your successes. The fifth rule is avoid emotional trading. One of the biggest dangers of any trader is allowing emotions drive their decisions. Whether it's fear, greed, or overconfidence, emotional trading can lead to poor choices and unnecessary losses. To prevent this, keep your emotions in check by trading with the right size, meaning don't put so much money into a single trade that you feel panicked and euphoric when it moves. When you keep your trades at a manageable size, you can stay calm, think early, and make rational decisions. Emotionless trading is the key to long-term success. The sixth rule is no setup, no trade. The importance of waiting for the perfect setup cannot be overstated. It's easy to feel impatient and want to jump into a trade just because you are eager for action. But in trading, patience pays off. If the market conditions don't align with your strategy, it's better to sit on the sidelines than force a trade. Rushing in prematurely often leads to poor results. So if the setup isn't right, no trade. It's better to miss a few opportunities than to enter a trade you are unsure of and risk unnecessary losses. And the seventh rule is follow the trend. When it comes to trading, there is an old saying, the trend is your friend. Trend exists for a reason, and trying to fight against them is like swimming upstream. It's exhausting and often unproductive. Instead, ride the wave of the trend and use it to your advantage. Whether the market is bullish or bearish, following the trend can increase your chances of success. Going against it, on the other hand, makes trading unnecessarily difficult. Always remember, it's much easier to go with the flow than to push against it. And there you have it, 7 golden rules of traders that can transform the way you approach markets. Remember, trading isn't about getting rich overnight. It's about consistency, discipline, and learning from every move you make. And if you have got your own trading rules or lessons you have learned the hard way, drop them in the comments below. I would love to hear from you. Thanks for watching, and until next time, happy trading.